Good morning, and welcome to TOITOI Japan Market Radio for Monday, April 13, 2026. I'm your host coming to you from Tokyo. This is your daily briefing on Japanese equities, the yen, rates, and the macro themes driving markets here, designed for global investors with Japan exposure or those actively monitoring the region. Let's dive straight into today's session.
Thanks for having me. So we wrapped the day with Japanese stocks under pressure across the board. The Nikkei 225 closed down 0.74% at 56,502.77. The TOPIX lost 0.429%, finishing at 394.8. Broader indices also declined. The Mothers Index dropped 0.525% to 2,464. And J-Right slipped 0.206% to 1,936. Meanwhile, the dollar-yen ticked up 0.39% to 159.732, so the yen weakened slightly. Crude oil was the standout mover, surging 7.135% to 103.46, while gold in yen terms edged down 0.251% to 17,895.
A pretty clear risk-off tone there, especially with oil jumping more than 7%. Let's unpack what drove today's session. The headline theme this morning was Japanese stocks staying under pressure after pulling back from a 6-week high. Can you walk us through what actually happened and why this matters for investors right now?
Sure. The Nikkei had rallied recently, hitting that 6-week peak, but today it couldn't sustain the momentum. We saw profit-taking kick in, and sentiment turned cautious. This is significant because Japanese equities have been reliant on a combination of foreign flows and export optimism, so any stalling at resistance levels raises questions about whether the upward trend has legs. When you see the market retreat from a multi-week high, it often signals that either the catalysts driving the rally are fading or new headwinds are emerging.
And in terms of those headwinds, what are the main factors global investors should be watching?
The big one today is the geopolitical backdrop. We're seeing escalating tensions in West Asia, and that's pushing crude oil prices sharply higher, over 7% as you noted. For Japan, which imports the vast majority of its energy needs, this creates a direct hit to the trade balance and corporate margins, particularly for utilities, transport, and chemicals. At the same time, higher oil prices feed into inflation concerns, and that complicates the Bank of Japan's policy calculus as they try to normalize after decades of ultra-loose policy. So the equity market is caught between rising input costs and uncertain monetary policy direction.
Right, so the oil surge is front and center. Let's talk about that in more detail because it's not just a Japan story, it's global risk-off. Markets across Asia and beyond slid as oil surged and those West Asia tensions intensified. How does this dynamic specifically impact Japanese markets compared to other regions?
Japan is uniquely vulnerable here because of its energy dependency. Unlike the US or even parts of Europe that have domestic production or diverse supply chains, Japan relies heavily on imports from the Middle East. So when tensions flare in that region, it's not just a headline risk, it's a fundamental cost shock. Higher crude prices mean higher import bills, which widen the trade deficit and put downward pressure on corporate profitability, especially for companies that can't easily pass costs through to consumers. That's a near-term negative for the Nikkei and TOPIX, particularly for cyclical and industrial sectors.
And then there's the currency dimension. We saw the dollar-yen tick up to 159.732 today, so the yen weakened a bit. How does that fit into the picture with oil spiking and equities under pressure?
It's a bit of a tug of war. Typically, geopolitical risk drives safe haven demand for the yen, which would strengthen it. But today the yen actually weakened slightly, and I think that reflects two things. First, the market is still pricing in a fairly dovish Bank of Japan relative to the Fed, so rate differentials continue to favor the dollar. Second, higher oil prices can paradoxically weaken the yen in the short term because Japan's energy import bill rises, increasing dollar demand. Over the medium term, though, if risk-off sentiment deepens and global equities sell off further, I'd expect the yen to catch a bid as investors seek safety.
So it's a balancing act between energy-driven weakness and safe haven strength. Staying with the currency theme, what does this mean for exporters? Presumably a weaker yen is still supportive for them, even if equities overall are under pressure.
Exactly. The yen at 159 plus is still quite weak by historical standards, and that provides a tailwind for exporters, autos, electronics, machinery. However, the offset today is the broader risk-off tone. Even if the yen is favorable, if global demand expectations are deteriorating or if there's uncertainty around supply chains and energy costs, then the benefit to exporters is muted. So we're seeing that push-pull in the equity market where export-heavy names might hold up better than domestics, but nothing is rallying strongly.
Got it. On the policy side, you mentioned the Bank of Japan and its normalization path. How do today's developments, rising oil, geopolitical risk, equity weakness, affect expectations for the BOJ going forward?
This complicates things for the BOJ. On one hand, higher oil prices feed into headline inflation, which could in theory support the case for further policy normalization or yield curve control adjustments. On the other hand, if energy-driven inflation is accompanied by weaker growth and equity market instability, the BOJ is unlikely to move aggressively. They've been extraordinarily cautious about tightening too quickly, and a risk-off environment with fragile equities gives them cover to stay dovish. So I'd say today's moves reinforce the view that the BOJ will remain gradual and data-dependent, rather than front-loading rate hikes or unwinding stimulus rapidly.
And what about JGB yields? In a risk-off environment with geopolitical uncertainty, we'd normally expect flight to quality into government bonds. Is that playing out?
Yes, that's the natural reaction. When equities sell off and geopolitical risk rises, investors typically rotate into safe assets like Japanese government bonds. That pushes yields lower. So even though the BOJ has been signaling a desire to normalize and let yields rise gradually, external risk-off flows can overwhelm that and compress yields in the short term. It's a dynamic the BOJ has limited control over in times of heightened uncertainty. For global investors, lower yields on JGBs might reduce the attractiveness of Japanese fixed income on a nominal basis, but the safety premium becomes more valuable.
Shifting back to equities for a moment, we saw the Mothers Index, Japan's growth stock gauge, also down today, 0.525%. Does that tell us anything about investor appetite for risk within Japan?
It does. The Mothers Index tracks smaller, growth-oriented companies, and when that underperforms alongside the broader market, it signals that investors are pulling back from risk across the board. It's not just mega-cap defensives being sold, there's a broad reduction in risk appetite. That's consistent with the geopolitical and energy cost concerns we've been discussing. In a more constructive environment, you'd expect growth stocks to outperform, but today everything moved in tandem to the downside, which reinforces the risk-off narrative.
And J REITs also declined, down 0.206%. That's relatively modest, but still negative. What's the read-through there?
J REITs are interesting because they're sensitive to both growth expectations and interest rate movements. The modest decline today likely reflects some concern about slower domestic growth and potentially higher financing costs if the BOJ does normalize policy over time. But the small magnitude of the drop suggests that real estate income streams are still seen as relatively stable. It's not a panic sell, but it's consistent with a cautious, risk-off tone.
So pulling it all together, we've got Japanese equities retreating from recent highs, oil surging on geopolitical tensions, a slightly weaker yen despite safe haven dynamics, and a BOJ that's likely to remain cautious. For global investors watching Japan, what are the key takeaways from today's session?
I'd highlight 3 things. First, the energy shock is a real headwind for Japan given its import dependence, and that's going to weigh on corporate margins and the trade balance in the near term. Second, the yen is caught between structural weakness from rate differentials and episodic safe haven strength, so expect volatility there. Third, the BOJ is unlikely to move aggressively in this environment, which means Japanese yields will stay low and monetary support remains in place, but it also means limited upside catalyst for equities from the policy side. For investors with Japan exposure, it's a time to be selective, favor exporters with yen tailwinds and strong balance sheets, and be cautious on energy-intensive sectors.
That's a clear framework. And I think the geopolitical dimension is something we'll be monitoring closely in the coming sessions, because if tensions in West Asia escalate further, that oil story becomes even more central to the Japan outlook.